For decades, Americans were told a simple story: debt matters. Deficits are dangerous, and printing money has consequences. But today, the United States is carrying nearly $38 trillion in debt. Interest payments alone are approaching historic highs, and yet there is no panic, no emergency speeches, no dramatic reforms. Instead, something quieter is happening. Interest rates rise, then pause. Liquidity is removed, then quietly added back. Rules that once defined the global financial system are being bent, sometimes rewritten without a single public vote. The mystery is not why debt is exploding. The real question is how the system is still standing and what the Federal Reserve is doing behind the scenes to keep it that way. To understand this, we need to go back to how the rules were originally written. The origins: when debt still had limits after World War II, the United States emerged as the world's economic anchor. The dollar became the global reserve currency, backed indirectly by gold and directly by American productivity. Debt existed, but it was constrained. For decades, economic growth outpaced borrowing. The Federal Reserve's job was clear: control inflation, stabilize employment, and act as a lender of last resort, not a permanent support system for government spending. But that balance began to change in the early 1970s. When the U.S. left the gold standard, money was no longer tied to a physical limit. Debt could expand more freely, as long as confidence held. At first, this flexibility seemed harmless, even helpful. The system worked until it didn't. The rise. Debt becomes the engine. By the 1980s and 1990s, debt was no longer just a byproduct of growth. It became a tool. Lower interest rates fueled borrowing. Financial markets expanded. Governments learned that deficits could be politically painless, especially when the Federal Reserve stood ready to stabilize markets during crises. Every recession followed the same pattern. Rates cut, liquidity injected, asset prices recover, and each time, the baseline level of debt rose higher than before. By the time of the 2008 financial crisis, the rules quietly changed for the first time. The Federal Reserve didn't just lower rates, it began quantitative easing, buying government debt at massive scale. This was meant to be temporary. It wasn't. The breaking point, when temporary became permanent. The real shift happened after 2020. In response to economic shutdowns, the U.S. issued trillions in new debt in a matter of months. The Federal Reserve absorbed much of it, expanding its balance sheet at a speed never seen before. This wasn't just stimulus, it was structural support. Interest rates were held near zero while inflation pressures quietly built underneath the surface. When inflation finally surged, the Fed faced an impossible dilemma: raise rates to fight inflation and risk collapsing debt markets, or protect markets and allow inflation to persist. The solution wasn't obvious rate hikes or cuts. It was something subtler. The fallout: rule changes without announcements. While headlines focused on rate decisions, the Federal Reserve began adjusting the plumbing of the financial system. Liquidity facilities were reintroduced under new names. Treasury markets received indirect support. Bank stress was managed quietly, not publicly. Most importantly, the idea of normal monetary policy was abandoned. At $38 trillion in debt, even small interest rate changes have massive consequences. The government now spends more servicing debt than on many core programs. So instead of letting markets fully reprice risk, the Fed is managing outcomes, slowing tightening without reversing it, allowing inflation to reduce real debt value over time, keeping financial stress contained. Not eliminated. The rules aren't gone, but they're no longer rigid. Failed fixes. Why traditional solutions no longer work: raising taxes doesn't solve the scale of the problem. Cutting spending risks political and economic backlash. Rapid deleveraging would destabilize the global system. Every traditional fix carries unacceptable costs. So policymakers default to delay, extend maturities, adjust expectations, rely on growth that may or may not arrive. This isn't collapse, it's managed imbalance. And history shows that this phase can last longer than expected. Until it doesn't. Modern parallels. The pattern-repeating empires rarely fall from one mistake. They fall from accumulated adjustments. Late-stage Rome diluted its currency. The British Empire relied on debt to maintain global dominance. The Soviet Union masked structural weakness with financial controls. In each case, the system didn't break loudly, it softened, adapted, and stretched until trust eroded. Today, global central banks are watching the Federal Reserve closely. Because when the reserve currency rewrites the rules, everyone else must follow. The danger isn't hyperinflation tomorrow. It's a slow shift where debt stops being questioned and discipline quietly disappears. 3 takeaways. First, $38 trillion in debt isn't just a number. It fundamentally changes how policy works. The Federal Reserve is no longer just managing inflation, it's managing solvency. Second, the rules of monetary policy haven't vanished, but they are being selectively applied. Stability now matters more than purity. Third, this system can continue longer than critics expect, but not without consequences. The cost is paid slowly, through currency dilution, asset inequality, and reduced flexibility. Final thought, the most important changes in financial history rarely happen with announcements. They happen quietly, in technical adjustments most people never notice. The question isn't whether the rules are changing. It's who understands the new ones and who doesn't. If you want more deep, pattern-based analysis on global power, debt cycles, and economic shifts shaping the future, subscribe to the channel. Because in the next phase of this story, understanding matters more than optimism.